Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. The last 10 days, pharma has made its presence felt, and how? From being a defensive sector to actually having a good performance in 2023 as well. But more importantly, this whole murmurs and then the subsequent passage of the BioSecure Act brought the CDMO players in focus. A virus here, a disease there, keeps diagnostics and healthcare in focus as well. So we thought it best to try and get somebody who probably eats, sleeps and breathes pharmaceuticals and healthcare in terms of money management on the show to try and understand from him, how does he think of the space currently and the various pockets or subsets within healthcare. Chirag Dagli, fund manager of the DSP Healthcare Fund, joins in right now. Chirag, great having you. Thank you so much for taking the time out. Good morning.
Thank you so much for having me.
Now, the pleasure is entirely ours. And Chirag, your fund's performance has spoken volumes about how well you guys have managed this space. I'd love to understand, how do you think about the things now? So first up, I'm going to bucket my conversation into 2 or 3 spaces, Chirag. I'm going to start off with the recent news flow on the US BioSecure Act. Lot of chatter around this, lot of talk about how, albeit while it's long term, there is a massive opportunity for CDMO, CRO players. Do you agree? How do you think about this?
So clearly there is an opportunity. Indian players are at the forefront of this opportunity. We've been very good at chemical synthesis for a very long time. And if you see, while this opportunity has always been there, it is only a very gradual process that, this increase happens. And what the BioSecure Act will do is that it will essentially accelerate that change. If you see, through COVID, everybody has been trying to de-risk their vendor supply chain. In COVID, we saw a lot of challenges through. So all innovators have been trying to do, if they are largely in China, then China +1. If they're largely in Europe, then Europe +1, and so on and so forth. And clearly, India is at that center of whether you want to do Europe +1 or China +1. So this has been going on for a while, below the scenes, while the litigation, the legislation has now come. But this has been in the process, in the progress, in discussions in boardrooms for better part of the last 12 months. And which is why you see most of the CDMO players in India reporting very, very strong inquiries, very strong numbers in terms of the RFPs, the proposals that they are actually seeing.
Okay, so Chirag, okay, now just trying to understand again, and maybe it's a repeat question, but I'm just trying to understand. Do you reckon that the benefits of something like this, potential benefits, could come in soon? Could it be delayed? And a lot of people were saying that the second half of the current fiscal will probably start seeing some green shoots for the CDMO CRO space. In fact, the companies were saying as well that forget the first half, but the second half will be very strong. I'm just trying to understand, could the BioSecure Act passage lead to that, or are there other factors? And do you also believe that while they've kind of lagged in the last 6 to 9 odd months, that the next 6 to 9 odd months could be constructive for them?
No, 100%. And this is irrespective of the BioSecure Act, right? The BioSecure Act is just still in process of getting official and so on and so forth. Any which way, companies were talking about a very sharp recovery in the second half. And typically for all CDMO companies, second half is much better than the first half. So a little bit of that is seasonal, but also their own order books, their own pipelines were such that the second half of this fiscal was expected to see a very strong recovery of the low base of the first half.
Okay, and final question on this, Chirag. Again, I know it's a very difficult one, but as investors, as an investor or fund manager, you're building out a hypothesis and then hoping for it to work. My question is your hypothesis over strong growth for the next few years based on BioSecure, RFQs, et cetera, for this CDMO CRO bucket? Is it possible to predict 2-3 years out, or are you playing it by the year?
No, I think it's a little more longer term, kind of a long, strong runway to grow. That's what whether it is biosecure or it is China plus one strategy that innovators have been following for post-COVID, it basically paves the way for a very strong, opportunity for Indian players. We've been very strong at chemical synthesis historically, and this plays to that strength. The opportunity is now present for a very long time. We can keep growing at that double-digit that kind of opportunity is present. Is what we're essentially saying.
Okay, so you reckon that it's maybe a 5 to 7 year runway of growth possible because of all of these factors, and
yes.
And could it be like above mid-teens growth or higher than that, or is it difficult to call?
What companies are effectively saying is that is how they're thinking about the growth opportunity.
Okay.
Whether that see, it can be anything. There can be many things that can go wrong. Their clients' products have to do well in the market. So there are lots of ifs and buts, but the opportunity certainly is present.
All right. Just a segue, because some of these companies are also manufacturers of APIs, right? What about that bucket? Because there is this hope that API growth will pick up. I mean, Granules has mentioned that in the last few conversations. Their numbers have looked okay too. Some of the other companies have shown that too. Is that looking okay, or is it very seasonal in nature per se?
So today what is happening in API is that margins are under a lot of pressure for the generic API business, in some sense, the commodity part of the business. Margins are under pressure across the board. Prices were correcting. But what we've seen of late, maybe over the last couple of quarters, has been that for many products, prices on the lows have now stopped falling further and stabilized in some sense. So API margins are at, I would imagine, such lows that I think they will trough out over here and probably pick up from here on, as we go along. But clearly margins are under pressure for the generic API business.
Okay, fair call. Now, Chirag, the other aspect is what to do with some of the recent developments that have happened in companies, kind of specializing in that, specialty drugs. I mean, suddenly we saw policy moves around cancer drugs, and some of the companies in that bucket have done really well. There have been other examples as well. Do you believe specialty drug makers could actually have a stronger runway now that insurance is also percolated, or health insurance has percolated, and people might have access to expensive treatments, which was not a case maybe 10 years ago? So just trying to understand, could specialty drugs of all kinds be showing a strong runway of growth, and are Indian companies there to benefit from this?
So specialty opportunity in India, right? Let's break the two pieces, right? One is in the developed market like US and Europe, etc., and then there's obviously in India. In India, I think we've seen most of the multinationals actually prioritize new product launches in India along with the developed market. So this is a big change. I mean, it's a gradual change that has happened, but 10 years back, this was probably not there. 5 years back, a little bit of this was there. Now, increasingly, we're seeing most of the multinationals actually launch their new products, their patented products in India along with the developed world. So that's clearly something they see the potential for India. And this is such a large market, right? 140 crore population. Whichever way you slice and dice this, there will be a small market like a Switzerland or a France that will just pop out of that. So the opportunity is clearly there. Companies appreciating that, multinationals appreciating that, and certainly launching products, on patent products along with the rest of the world in India. Now, so that's the India piece, right? In the meanwhile, incremental innovation and a little bit of innovation that has been going on for a very long time, and that continues in the Indian market. Now, coming to the specialty part in the developed world, some of our larger companies have actually shown the way that this is a very this is not a small, this is a very, very balance sheet heavy, needs a lot of cash flow, big, long gestation period, etc., to do well in the specialty piece. But some of our leaders in India have actually risen up to that opportunity and shown the way of how they can succeed of selling specialty patented drugs in the developed world. And more of this will happen, I think, as some of our as some of the companies lower down also reach a certain threshold of financial cash flows. They will also look to enter some of these markets with own specialty products. So, but that's some time away before we start seeing some, where we can say that Indians are now doing very well in specialty in the US. That I think today we are only seeing a couple of companies as a trend. It might take some time for it to develop.
Okay. Okay. Now, Chirag, where within this whole healthcare construct or the healthcare space are you the most constructive on? Because there are various buckets here. Where are you most constructive and why?
So, as I always say, healthcare is not just one sector. There are multiple buckets. You put the India formulations, the export formulations, APIs, CDMO, hospitals, diagnostics, and now we have retail pharmacies as well. So multiple of these buckets. Each of these have opportunity to grow in double-digit kind of a range. Is how we are kind of thinking about this top-down. Now, as far as capital, generally these markets, these businesses don't have too many cycles per se, right? Sure, they will go through a little bit of RM prices, volatility, some bit of seasonality in demand, etc. But by and large, businesses are not very cyclical. If you look at a long-term chart of demand of these products, of each of these, you will see a secular kind of increase. So that kind of continues. But capital markets have their own cycles of whether they prefer this versus that, depending on news flows and so on and so forth. So capital markets have their own cycles within these buckets. The businesses themselves don't have too many cycles. The only piece which is cyclical in the entire basket of multiple segments is commodity US generic business, which goes through a bit of a cycle. And last 12 months, we've seen a little bit of an upcycle from the lows. We've seen a little bit of an upcycle in the US generic business. And that I think will continue for some time. So, so that's just the lay of the land. And if you say, if you ask me, where is the opportunity? I think the opportunity is across the board in each of the buckets. There are stocks, there are opportunities to invest in. But if you just kind of list down the multiple buckets in terms of growth, then clearly CDMO API will be up there in terms of the mid-teens kind of growth potential, whereas hospitals diagnostics will be somewhere lower, maybe in the 12 to 14% kind of range. And then you'd have the Indian pharma, which will be in the 10-11% kind of range. So that is how the growth will stack up. That's how we broadly kind of look at it.
But Chirag, relative to the valuations existing, would the higher growth companies still be the favorites because they might be trading expensive? I mean, I look at the valuations of a Syngene, a Laurus, etc. They are very, very expensive companies. So do they still remain favorites, or I'm not saying they are your favorites, but I'm just trying to understand in the pecking order, would they? Some of them might be expensive as well. So valuations versus growth perspective, what would stand to be the favorites?
So, I mean, I think across the board, most sub-segments have seen a big re-rating. Even India businesses, which used to trade at a premium to export businesses, even on higher multiples 12 months back, those businesses have actually re-rated much higher. So tough to call, separate out a section where you will see that this as an entire space, the valuations are very attractive. Within spaces, you have to keep looking for opportunities is how we think about this, Niraj.
Um, okay, so I'll try and pick up one by one. We've spoken at length about the BioSecure Act and CDMO, CRO, so leave that out. Now, hospitals. Let me try and come to this. A lot of chatter around new bed addition, consolidation within this space with the larger chains gaining over some of the others. That's the other piece that I hear. And then I hear, of course, about the fact that, or about the possibility that branded chains would stand head and shoulders above the others and therefore gain both in revenue growth and valuations. I'd love to understand how you think about hospitals.
So clearly, what we've seen in the last 3 years is that most hospital companies have reported double-digit RPOP growths. And clearly, that's not something that's sustainable. A part of this is a mix of both case mix improving, the maturity profile of the hospital overall improving. Clearly that sustaining double digit RPOP growth looks unlikely as we go along. I think a more reasonable expectation could be a single digit RPOP growth and probably a single digit kind of patient volume growth, and that blended into an overall 12% kind of 12-13% kind of growth is the construct in the hospital space. When you think of the larger chains, the listed ones, clearly they're gaining market share. Clearly, we're seeing that there's a lot of potential for these companies to, so two things are happening. One is that in their core markets where they have a very strong brand name, they are expanding brownfield capacities at existing locations. The other thing that is also happening is that there's a lot of M&A that is happening, that standalone hospitals are actually getting corporatized in some sense, selling themselves out to corporate chains. And this works well for both, right? So let's say if there's a doctor-run, hospital, 100, 200 bed hospital in a city, a doctor can, take it only so much because he's doing both the administrative work as well as the clinical practice. When they get attached themselves to a corporate structure, the admin part just goes out, right? The corporate structure manages the admin part, whereas doctors can just focus on their clinical practice. So it's a win-win for both. And that structure we're increasingly seeing a lot more come through. And I think as far as the opportunity to grow on their own, this whole brownfield expansion in cities where they're already present and have a very strong presence, that also seems to be continuing. So the opportunity is certainly there. Most companies are talking about doubling of bed capacities over the next 4 to 5 years at the very least.
Okay, but so and between hospitals versus diagnostics, a lot of people tend to make that comparison. We're trying to think whether you want to buy either or. Do you kind of look at them that way, and do you have a favorite between the two?
So look, tough to compare the two businesses. Hospitals clearly asset intensive business, high entry barriers. You need almost about 100 licenses to start a hospital, right? So if you and I decide to put up a hospital in a location today, the hospital will come up in 3 years. It will run at EBITDA losses for another 2, maybe 3 years, and then start making money. So very high entry barriers in hospital. Diagnostics, on the other hand, there's hardly any capital required in the business, very low entry barriers, etc. So the two businesses are very, very different. Both offer similar growth, I would say, maybe plus minus, some bit, but similar growth. But capital efficiency is much higher in diagnostics. So to pick favorites, difficult, I would say. Valuations across the board are high. Within pathology, or rather within diagnostics, much easier to pick up a radiology business because it's just difficult, much more difficult to disrupt a radiology business. And within hospitals, just much easier to pick up a a multi-speciality hospital chain which can which can deploy the capital that its existing beds are generating, the cash flows that its existing beds are generating to grow and build more beds. So that's how we think about this, rather than comparing diagnostics with hospitals. You try to compare within hospitals which are the hospitals that can potentially grow through internal accruals, and from the existing beds that are there in their base, the capital that is generated from there, can they deploy into newer markets, newer geographies to grow, is how we kind of think about this.
Are you constructive hospitals? Are you constructive diagnostics currently?
Constructive, but I mean, valuations are a punchy, little bit punchy, clearly. And one of the things we've seen in diagnostics is that pre-COVID, all of these companies used to grow in the mid to high teens range. Through COVID, there was a lot of challenge, etc. And growth X of the COVID business had actually come down to very early double digits, 10, maybe 11%, that kind of a number. And that now is inching back up to 13, 14% is what we are seeing. We're seeing a little bit of growth acceleration come back in the diagnostic companies. That's one change that we see. But that said, clearly valuations are punchy.
Okay, valuations remain punchy indeed. Okay, the last couple of pieces, Chirag, that I would want to understand from you. Where is it that you believe the next triggers of growth come in? Again, very wide bucket. So it's a bit of an open-ended question, because you yourself counted out about 7 or 8 buckets. So no one trigger will work for each. But I'm still trying to understand, because you probably look at the whole space, or from within the buckets that you look at, where is it that the next big trigger is likely to come in? Like for CDMO, the BioC Secure Act was supposedly the big trigger in the minds of people. Where do you think the next big trigger comes in for any of the buckets that you are looking out for?
So I think the next big negative trigger can be some regulatory action. Clearly, that's one of the big pieces that worries us a little bit. And this is across businesses, whether it is in pharma manufacturing, whether it is the US FDA, or it is hospitals, or or the domestic market, price control, and so on. So that is something that is a little bit of a uncertainty there. Apart from that, in terms of growth triggers, I think this business across the board just keeps chugging along, right? CDMO, while today we talk about BioSecure Act, etc., but the underlying trends of doing this de-risking away from China or away from Europe, these have been around for better part of the last 12 to 18 months. So I'm not sure if I can identify any milestone that this is going to happen and that's going to lead to the next big move, etc. I'm not sure if I'm able to identify any such events or triggers.
Okay, my final question to you, Chirag, and that is on the big pharma out of India, right, which have this large US exposure or global exposure. And I'd heard enough people talk about how the pricing pressure might go off, then talks of the pricing pressure coming back, then Revlimid helping some of these players in posting very strong revenue, and then conversation now starting to come in of generic Revlimid or some of the drugs, probably ending the massive revenue boost that they gave to 2 or 3 companies in particular, but maybe a lot of others too. So I'm trying to understand what happens to the Sun Pharmas, Reddy's, Ciplas, Lupins of the world, Aurobindos of the world over the course of the next 24 months. How do you see that picture?
So 2 things happen. One is that the US-based business, right, which is the traditional commodity, fully generic kind of business, that continues to chug along. Price erosion remains fairly benign, and that prognosis that we have, that price erosion will remain benign, that will continue over the next 12 months for sure. As far as the big products are concerned, and Revlimid is just one of them, as far as the big products are concerned, some of these will just stop off, right? So Revlimid will become fairly commodity product starting January 2026, maybe earlier, as this is a date certain, and this it's a market, so players may behave differently. So that's certainly happening. The way we are approaching this is that companies where there's a very high profit uh, contribution from a couple of products, and where valuations are also a little punchy, we're staying away from such companies, is how we are kind of thinking about this. Wherever there isn't very high or not as high product concentration, those companies still we continue to own. So a combination of higher multiples with higher product concentration is an absolute avoid, is how we are kind of today thinking about this whole US business across multiple players.
Okay, well, it's a difficult space to invest in. Some pockets have triggers, some pockets have future triggers, maybe some negative ones as well. Chirag, Dagli, they're laying it out beautifully for us. Thanks so much, Chirag, for taking the time out and being with us. Really appreciate it.
Pleasure. Thank you so much.
All right, that's the view on Talking Point today, viewers. Thanks so much for tuning in.